Welcome to the No-Nonsense Guide to Investing, focusing on index funds versus individual stocks and deciding which strategy fits your financial goals. The big question in investing is, do you want to own the basket of assets, which represents the entire market, or pick individual seeds, which are single stocks? This decision centers on diversification versus focus. Index funds offer broad diversification across hundreds of companies, reducing individual risk. Individual stocks are high-conviction bets on specific companies for potentially higher returns. What is an index fund? Think of it as a pre-packaged investment. By buying one share, you instantly own a tiny piece of the entire market, or a large segment of it. A stock represents direct ownership in a single business. When you buy a stock, you share in its profits, its growth, and its potential failures. Index funds provide instant diversification. A single S&P 500 index fund gives you exposure to the 500 largest U.S. companies simultaneously. Consider the time commitment. Index funds require minimal time, perhaps 1 hour per year. Stock picking, however, requires deep research, report analysis, and constant monitoring, often taking 10 or more hours per week. Regarding the probability of success, an index fund gives you an 85% probability of matching the market. Statistically, most professional fund managers fail to beat simple index funds over 10+ years. Looking at the growth journey, index funds offer a steady, smoother path, while individual stocks are generally much more volatile, represented by the dashed line. The three cost factors are important. Index funds have near zero expense ratios. Frequent stock trading means higher trading fees. Index funds also offer better tax efficiency due to lower turnover. Consider your mindset. Can you watch a single stock drop 50% without panicking? Index funds help you stay calm by smoothing out the bumps through broad exposure. As Warren Buffett, one of the world's most successful investors, states, a low-cost index fund is the most sensible equity investment for the great majority of investors. When should you choose individual stocks? If you have deep curiosity, you are math savvy, you have a high-risk appetite, and you have a long horizon of 10+ years. These four factors indicate readiness for stock picking: deep curiosity, math savvy, risk appetite, and a long time horizon for your investment. A hybrid strategy can be optimal: 70% core investment in index funds for stability, 20% satellite with a few high-conviction stocks, and 10% speculative for high-risk moonshots. The best time to start investing was yesterday. The second best time is today. Take the time to understand your personal finances and begin your investment journey now.